Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The ISM manufacturing number, that price is paid. That's something. It jumped quite a bit in March also.
Yeah, exactly. So I'm looking, and so that data, we're going to break it down in just moments, but I'm looking at also the JOLTS data, a little bit lower, 8.5 million. The consensus was like 8.68 million. So the JOLTS openings, but a little bit fewer job openings out there.
Yeah. So, okay, if we all paint the brush, we have a slowing-ish
that's
economy with inflation still-ish high. Tim Fiore is the man behind the ISM. He is chair for the Institute for Supply Management. He breaks down all the data for us. We love giving you this instant analysis of the data as it crosses the terminal. Tim, always great to see you. Walk us through these numbers.
Yeah, good morning, everyone. A little bit of a disappointment, but not, don't overreact to it. There's so much emotion around the 50.51 versus 49.9. So we came in at 49.2. We sagged a little bit. The four elements that I watched for demand, three of those weakened a little bit. But I think this is just a bump in the road. I believe we're still on the track of expansion that we started in January. On the output side, the revenue was good. We're still destaffing, but not as much as we were in the prior months, which I think is the appropriate thing to do. And the big disappointment this month was really the input side, where the suppliers are still delivering faster, which is a bit of a surprise at this point. And the manufacturing inventory account is still contracting, again, a surprise. And as you mentioned, Alex, the prices number coming in at almost 61 is definitely an eye opener. So did a bit of research on that, and it seems to be all commodity related. It's steel, it's aluminum, it's plastics, and to some extent crude oil driven, petrochemical driven, but not as much as the basic foundational commodities. So, I think we hit a little bit of a bump here, but I still believe that we're on the growth trajectory.
So, Tim, do I interpret that prices paid, again, it came in at 60.9 versus a consensus of 55.4 and a number last period, 55.8. So the higher prices paid, so I take that as inflationary, right?
Well, it means that in the month, people paid more people paid higher prices than they did in the prior month. Okay. So you could say that they're faced with higher prices for sure.
And you mentioned it was commodities. So understood that, okay, commodity pressures can be transitory, but nonetheless, walk us through the inventory, production, and new orders. So inventories are unchanged. Production fell and new orders fell. So is that just that companies have restocked enough and they can hang tight for now, or is it an end demand issue?
No, they fell, but they're still expanding. So they slowed their rate of growth.
Okay.
On the production side. We had a bit of a surprise, I think, last month on the production number being so strong from something that was slightly contracting, I think, the prior month or at flat. So we're still expanding, but at a bit of a slower rate. So that's positive. On the employment side, we're still contracting, but at a slower rate. So we're not letting as many people go, which I think is appropriate too at this point. At the end of April, if the second half of the year is going to be stronger than the first, then at some point you got to stop letting people go. And I think we talked about that last month, and I think that's happening now. So nothing unusual on the output side, I think. I would love to see a much more robust production number, but it just wasn't to be in April. Remember, April's a pretty strong manufacturing month. It's really the beginning of some pretty heavy output. So there's some seasonal factors in here, but I'm not going to say that that's the issue. I think we had a bit of a bump. I'm still optimistic about May. The pricing number is obviously concerning. We've had a couple of months here of growth. It's foundational, which on one hand, you could argue, okay, that's because demand is coming back and prices are stabilizing and in some cases growing. If that's the case, all right, fine. But you still have to deal with the inflation number.
Great stuff, Tim. Really appreciate it. Thanks for the instant analysis. We know you have a busy day for you. Tim Fiore of the ISM manufacturing team. He's the chair of that. ISM manufacturing coming in a little bit light. Prices paid jumping to over 60. Although Tim trying to even it out, saying, you know what, it's a bump. Relax. May could still be good. Let's not overreact.
Yeah, we'll play it by ear. So again, looking for the trend there, but a little bit of a concern there. We'll take a look.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Dennis Lockhart joins us here, former Atlanta Fed president, joining us from Atlanta. Dennis, I have to ask you before we even start, if you tell me your office is located on Peachtree Street, I'm going to jump out the window. Is it on a Peachtree Street?
Indeed, it is.
See, see.
My current office, which is my home, is on Peachtree Street, and it's about 5 or 6 miles north of the Fed office, which is also at 10th and Peachtree.
See, I mean, before there was Google Maps, or I got lost in Atlanta every single time because every single street is Peachtree Road, Peachtree Street, Peachtree Avenue, north, east, southwest. I don't know.
Every handle you can put on the word Peachtree is used
and
here
we're
in
saying
Atlanta.
peach, right? Like
Peach.
the fruit?
Yes, Peachtree. You know,
Okay.
it's a phenomenon just specific to Atlanta. I don't know. I know they've got a secret code down there. Dennis, what are we going to hear from our Federal Reserve today at 2 p.m. Wall Street time?
Well, I think, first of all, I don't think the statement is going to break new ground. So I think it's really a question of Powell's press conference. I think he needs to kind of thread the needle here, come off as a bit balanced. I don't think he wants to encourage any expectation of a near-term cut, meaning at the June and July meetings. But I don't think he also wants to abandon the idea that that this year we will see some rate cuts. And to add to that, he probably cannot take off the table the scenario in which there's a rate hike. So to me, he's got to come across as balanced and measured and in a certain sense non-committal.
Which I'm sure he's going to try very hard at all the 17,000 questions that ask about a hike to do that. How, in your experience, and you're taking a look at the economy and the data that's coming in, which is showing some softness, how quickly can an economy cool? How soft can an economy get, knowing the data points we have right now?
Short of a shock of some kind, a supply shock is what we've experienced recently, I think the cooling will be gradual, and it will be in a way fighting something that seems to be fueling the current resilience in the economy, and that is that we have a very good employment economy. When people are employed, they tend to have confidence in their income stream, and consequently, they tend to consume. And that's what's, simplistically at least, that's what's driving the current strength of the economy. So we're going to have to see some consumption slowdown, which so far we really haven't seen a lot of.
Dennis, there are some folks out there that are making the argument that the Fed pivot, if you will, in December to a more cautious, more dovish tone, that actually contributed to some of the inflation we're seeing here in the first quarter of 2024. Do you buy that?
Well, inflation expectations have risen a little bit. That's always a red flag for the committee. They get concerned when they see expectations rising, and we've seen that happen. That, on balance, should be a cautionary note, that means they're going to maintain their posture of, I would say, slight hawkishness in these circumstances.
To build on that point, I mean, you look at financial conditions index, like it's not tight. So when the Fed says things like, we think that we're at restrictive enough policy, why do they think that?
A very good question. It may very well be a question that they're reconsidering.
Oh, wow.
I think, we've seen the economy tolerate this level of interest rates with apparently very little problem. The economy continues to move along very robustly, even with the current setting of policy. So it wouldn't surprise me at all if individuals, at least in their Fed speak after the meeting, say that they're not so sure that the setting of policy is as restrictive as they thought. Now, one thing to keep in mind is the 10-year has moved from about 430-ish to for 65 to 70, and that's tightening. That's not tightening policy, but that's tightening financial conditions, and we've seen that in the last few weeks.
Yeah, to be fair, I mean, this is why I take notes, Paul.
I know.
Because this was an Ira Jersey thing from yesterday, and I was like, that's a brilliant question. I'm stealing it, and I'm writing it down. So there you go,
Good.
Paul.
It worked.
That's why I do it.
Dennis, is there a scenario here for 2024 where there are no rate cuts?
I don't think you can dismiss that idea. I don't think it's the base case at the moment, and I don't think the committee, importantly, has abandoned the outlook or the view that they will ultimately cut rates later in the year. But I don't. I think it's a non-zero probability that there are no rate cuts this year.
So we'll have to. I guess 2 o'clock we'll hear from the Fed here. I guess also, Dennis, just real quick, a rate hike, is that something that you think will be discussed or was discussed yesterday and today?
Definitely going to be asked.
Yep.
I think at this time, Chair Powell and the committee overall probably don't want to entertain a rate hike as they don't want to create the market aftermath that would occur if there was a serious discussion of that. But at the same time, Powell can't take it off the table because he's got to keep, I think, the committee's options open to deal with whatever develops in the coming months.
All right, Dennis, really great perspective. Thank you so much. Dennis Lockhart, former Atlanta Fed president, joining us from Peachtree Street, we decided?
Yeah, so in the bio page, I mean, it's Peachtree, and it's Peachtree Street, Peachtree Road, Peachtree Avenue, and it's not just that, northwest, southeast, northeast, and so
I would
literally
totally get lost.
And you'd be sitting there and you give the cab driver an address, and if you didn't have it exactly perfect, he'd take you to a completely different part of town.
Oh,
like 40 minutes away. I mean, it was crazy. I'm like, he'd be taking me somewhere. It's like, this isn't Invesco.
You're like, this is somewhere very different.
Yes.
The things we learn here on Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix Steele alongside Paul Sweeney. We're live from Interactive Broker Studio right here in Midtown Manhattan. This is the Bloomberg Intelligence radio show where we cover all the top economic and financial news for you with a lens through our Bloomberg Intelligence analysts. They have an amazing coverage scope, 2,000 companies, 130 industries all around the world. We also tap our super solid lineup of external guests as well, who really knee deep in all the data that we're getting. The latest is that ISM manufacturing data, disappointing. The JOLTS number also coming in a little bit lighter, but yet still relatively strong. Jeffrey Cleveland is chief economist over at Payden Regal. He joins us now from Los Angeles. Jeffrey, it is Fed Day. It is a big day. A success for Jay Powell would probably be a nothing burger. What kind of burger do you want?
Well, okay. I was hoping for some more excitement, actually. Happy Fed Day to you, Alix. We're not going to get any move on rates. I don't see a lot of incentive for the Fed chair to try to move markets. Markets have moved toward, a more hawkish stance, removing a lot of the policy accommodation that we saw priced in at the start of the year. So I don't know that he needs to do much, but I was hoping maybe just to stir up something, we could get an announcement on the balance sheet. So put aside rates, and they have been doing this quantitative tightening for most of the last 2 years. And they said, or at least Chair Powell said, he wanted to fairly soon begin the process of slowing the pace of balance sheet contraction, if you can follow that. So that could be something that's announced today to start in June, or maybe they put that announcement off till June. I don't know, but that's one idea for some excitement today.
So, Jeffrey, from your perspective, looking at the economic data that you see, what do you think the Fed should do?
Nothing at all. I think on the funds rate, they just sit here. There's no compelling case to cut interest rates at this point. That GDP report, last week, if you exclude some of the volatile components, we still see the underlying pace of growth in this country at around 3%. We think we could get a figure like that at an annualized rate in Q2, which would be excellent. The unemployment rate's low. all the inflation data in the first quarter picked up relative to what everyone had hoped for. So whether we're talking CPI or PCE or ECI from yesterday, right? So everything's picked up. So there's no compelling case here to cut rates. I don't know that there would be it would take a few months. If I'm a policymaker, Paul, I want to see at least 3 months of inflation data that's much cooler than we've been witnessing. So I think that rules out doing anything for now. That's why I thought the balance sheet would be something they could do with their time in the interim.
We were just talking about this in the previous segment. Why does the Fed, and do you agree, that the policy is actually restrictive enough? When you take a look at financial conditions, they are so loose. So what gives them the confidence to say policy is at a restrictive enough point?
Well, there's this hypothetical thing they have where they look at the neutral rate, they look at the policy rate relative to that. They say we must be at a restrictive setting. Lots of bond people will also look at real rates. So if you look at your, tips imply your real rates, or you look at a nominal yield minus some measure of inflation, it's positive now. It's been negative for quite some time. So people think that's a restrictive. I'm a simple man, so I just look at growth, inflation, the unemployment rate, and I think the jury is still out, Alex. It's TBD whether we're actually that restrictive. I just got back from Europe. I was in Germany. A lot of clients over there asking that question. And one thing I said was, hey, maybe interest rates are just going to take more time to bite. The U.S. consumer is more insulated from rates. We've got 30-year fixed mortgage, for example. Many of my corporate clients, they've termed out their debt, and they're earning income on their assets, their savings that they've accrued. So they're actually earning income at higher rates here. So maybe they're more insulated from the interest rate increases that we've seen. So the U.S. economy is very resilient. I think it's tough to make the case things are very restrictive at the present.
Jeff, we had some ISM data come out earlier this morning. 49.2 was a headline number versus a consensus of 50. We had Tim Fury, who heads up the ISM, saying he's not too concerned about it. It's a data point. How do you think about just kind of the overall economy here today? Is it strong enough from your perspective that the Fed, in fact, can just kind of wait?
Yeah, it is. I got excited when we jumped back above 50 on ISM. We've been lingering below that. I got to admit, that was an exciting moment for us. We did a chart of the week on that. But probably the most worrisome aspect of that ISM, Paul, prices paid.
Yep.
Yeah.
Correct me if I'm wrong, but I believe they leapt back up to 60.9 on that gauge.
Right.
So again, maybe the real story here is, we've had some manufacturing weakness for some time, so that's not really new. But the resurgence of some price pressures, that might be the real story here. And that's consistent with some other price gauges in Q1.
Right, and that's something that the Fed can't do anything about. Like if that's a commodity pass-through thing, and even if it stays higher, they can't do anything about that point, in essence. Here was my question from earlier. If we don't get a cut this year, could that be seen as a de facto hike?
Well, it's definitely a tighter policy than financial market participants had anticipated, at the start of the year. I remember on this program in January, we were talking, I think there was 150 basis points of rate cuts priced in. That definitely had an impact on financial conditions, whether you're looking at a 2-year yield or a 10-year yield. So the consequence of the removal of those rate cuts is, tighter financial conditions across the board. But I just keep coming back to it when talking to clients. It's happening for a good reason. It's because growth is holding up. The economy is more resilient. We're talking 3% growth. That's not a terrible environment. I guess if we went back, 5, 6, 7 years, and I told you we'd wake up in 2024 with 3% growth, 3.8% unemployment rate, a little bit higher, 3% inflation, you would take that deal, I think. It would be okay for corporate earnings overall. So I don't know that it's a disastrous scenario here. It's disappointing if you expected a lot of rate cuts, which we did not. So not too disappointed.
Jeffrey, how about the U.S. consumer? We're going to get some earnings starting next week from some of the retailers. How do you think the U.S. consumer is doing out there? Because there's a lot of crosswinds out there. It's tough, but certain parts are doing okay. How do you view the consumer?
I think, I talk to a wide range of clients, and some of my clients tell me, hey, I don't care that inflation has cooled off, Jeffrey. It was 6% on this core measure you're talking about. Now it's 3%, big deal. Prices are still high. Paul. That's what they tell me. It's the price level that I think they're referring to. That's the term we would use, right? And so that's still, I think that's still weighing on a lot of consumers. There are consumers that are seeing pretty good wage gains, but not all. And we think you're seeing that show up in some areas. So we're seeing that in credit card delinquencies. We're seeing that in some of the auto delinquency numbers. So it's something we're watching very carefully. I have to tell you, though, in aggregate, when I see aggregate nominal consumer income still growing at around 6% year on year through the latest month of data, that is pretty good. That can smooth over a lot of the other problems that we see out there. So some signs of weakness, but overall, U.S. consumer is in still great shape, I think.
So before we let you go, it is the question, Jobs Day Friday. What are your numbers?
I think reasonable guess is somewhere around 200,000. Wouldn't be surprised by that. Which would be great. We think you only need 110,000 jobs to keep a lid on the unemployment rate. So that should keep some downward pressure on the unemployment rate. Another great month of job growth, I think. So we're expecting pretty solid growth to continue here in the April data.
All right. Jeffrey, thanks a lot. We appreciate it. I hope for your sake that it is not a nothing burger, that you can get excited. It does feel like Jay Powell would like it to be a nothing burger, so we'll see if that actually happens. Jeffrey Cleveland, chief economist at Payne & Regal, is standing by.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele and Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So you head over to youtube.com and search Bloomberg Podcast, and that's where you will find us. Of course, it is Fed Day today. We'll hear from the Fed at 2 p.m. Wall Street time conference with the reporters at 2:30. Bloomberg Complete coverage on Bloomberg Radio and TV at 1:30 p.m. Wall Street time. Let's check in with somebody who I think is going to be paying attention to this meeting. Priya Misra, Managing Director at J.P. Morgan Asset Management, joining us from New York City via Zoom. Priya, thanks so much for joining us here. I guess what we've heard from a lot of people today that Alix and I have been chatting with is the expectations are pretty low here, that the Fed's going to try to stay a steady course here. Any chance that they maybe kind of go off script a little bit and maybe be a little bit more hawkish than maybe they had been?
So I think they have to mark to market, meaning in January and March, Chair Powell said he'd like more confidence, or the Fed would like more confidence before they can cut rates. They haven't, or none of the data should give them more confidence. So I think they have to acknowledge it. I would argue Chair Powell's already acknowledged that. I think repeating that and keeping the market and the market's already priced that in. We've taken down the number of cuts that the market was pricing in for this year to now about 30 basis points, much later in the year. So the market's already, I think, priced in a Fed that should not have had more confidence to cut rates. I think reiterating that should be relatively neutral for the market. I think what I'm watching is, does Chair Powell show that we need more time, that the Fed needs more time to get that confidence? Or is his belief that the disinflation process is still underway, is that belief a little challenged, or is he losing faith in that? I think then you can see a much bigger reaction, because if the Fed starts to get nervous that monetary policy is not restrictive, hikes come back on the table. And I think then no market is really priced for that. I think risk assets will really struggle if the Fed is talking about rate hikes. I don't think they're there yet, but there's a press conference and I know he's going to be asked that question. And if he sounds a little more nervous about the hot inflation readings, I think then the market's absolutely going to pay attention.
What is appropriately priced then? If you're looking at a 10-year, I'm at 4.65%. You're looking at a 2-year barely above 5. Are these the right levels? What do you do here?
So I think if rate cuts are still on the horizon, and they could be later this year, they could be next year, I think the rates market's actually very well priced for that. I would actually argue that at 470 on the 10-year, we're near the peak. If the Fed is not going to hike any further, I actually think owning some duration, we've stepped in a little bit. We're a little long duration looking for levels to add to that. So, I think rates then would be near the peak. If the Fed suggests that they may be taking rate cuts off the table, or heaven forbid, talking about rate hikes, I think then absolutely rates can rise some more. You can breach that 5% level. But as long as they are dangling that rate cut carrot in front of the market, I think, even if it's a little further out, I think actually rates start to look fair to cheap. Look at all-in yields. Investment grade corporate, you're getting 6%. Securitized credit, you can get 7, 8%. I mean, you're looking at equity-like returns in fixed income. So as long as we're not talking about rate hikes and cuts are still on the horizon, I think fixed income makes sense. You just have to be careful. You know what risk you're taking in terms of credit. But, I think rates should be near their peak.
And that's kind of where I want to go, Priya. I was just wondering when, pros like you, when you start thinking about credit risk and maybe taking on more credit risk, because I think about the performance in the fixed income space in 2023, against at least my expectations, the best performing asset class was U.S. high yield. So I'm wondering if I should be taking some credit risk here.
Sure. We've been adding credit risk really since late last year. Once the Fed suggested that they were done hiking, that's normally a good sign for risk assets as well as duration, as long as the fundamentals are strong. And that's where I think if you rely on research, we have a ton of research analysts looking at fundamentals of the company. You talk about high yield, the company fundamentals of high yield, of investment grade, are very strong. I mean, there are those companies that are struggling, but being extremely careful about the business model, about the balance sheet of, even high yield. I think high quality, high yield makes sense. We've been adding that risk. I think the other thing we watch are flows. And we've had significant inflows into fixed income. Net supply of fixed income has not been that high. Companies have been issuing paper, but really to refinance their debt, their upcoming debt. We haven't seen the re-leveraging up of the corporate sector. It's something I'm keeping an eye out for because spreads are tight. If companies start to re-lever, I get a little more nervous. But you look at the supply-demand picture for high yield, for investment grade corporate, it's strong. Company fundamentals are strong. That would be an argument for as long as the soft landing continues, economic data remains strong, the consumer is strong. I think owning some credit risk, makes sense. Owning some duration risk closer to that 4.75% level starts to make sense as well. So I think both of those risks are attractive here.
Priya, one of our YouTube viewers just kind of wrote in and said, is that the Empire State Building out your window, or is that like a screensaver kind of Zoom thing?
Well, right now it is a screensaver, but once our building is up...
I thought it was real.
Once the JP Morgan building is up, I'm hoping, probably not from my office, I stare at screens all day long, but I'm sure there will be views from that
You're going to get some great views. And by the way, we're going to do a remote broadcast from down there when that building opens. That'll be cool.
That's exciting.
Yeah. So.
Okay, cool. All right, Priya, if you take into account, you mentioned sort of taking on the credit risk, et cetera, how do we think about all the supply that's going to come on in terms of where you may take duration risk, where the credit risk then lies? And I say supply, and I mean from Treasury, but also in terms of issuance on the corporate side.
Sure. So a lot of corporate issuance has happened. I think there's been significant pre-funding earlier this year. So we are looking for less corporate supply on a gross basis into year end, particularly as we go into the election. But I think as we look at the spread curve, and I'll get to the rate curve in a minute, but the spread curve is pretty flat. So we like owning the 0 to 5 year part of the spread curve, just because, to take on more additional credit risk, just not getting paid up enough. So, if the spread curve steepens, I might look further out, but I would say 0 to 5 year. When we talk about the Treasury curve, and that's where we have a lot of supply, and there's no pre-funding. There's going to be Treasury supply as far as the eye can see for multiple generations, given our deficit outlook. I think there it's important to think about what does the Fed do? And given our view that the Fed is likely to start to cut rates, we think in the third quarter, a couple of times this year, a few more times next year, I think that 0 to 5 year is attractive. But given that the cuts don't seem to be imminent, I think the 3 and 5 year is a little more attractive because, the negative carry of owning that 2 year is high. So I would say owning 5 year duration and 0 to 5 year credit, that's really, I think, the sweet spot in the fixed income space right now.
All right, let me bring up an old issue here, Priya. That's the inverted yield curve. We're still inverted 2s, 10s, 35 basis points. And I was taught by none other than Professor Cam Harvey, who kind of penned this whole thing, that usually leads to, like always, a recession. What's going on there with the yield curve?
So the Fed has historically struggled to engineer a soft landing. They did so in 95. I think 2019 might have been another case, except we had COVID, so it's really not really a tested period. But here's why people look at the yield curve and say that that's a sign of a recession, because it's typically end of cycle. The Fed has tightened policy significantly, and then we head into a recession, and the Fed then tries to cut rates to counter that. I think they're trying very, very hard to keep the soft landing going. And that's why the talk of rate cuts. I think they want to take the edge off the market, start cutting rates. If the earlier they start, the slower they can cut. And perhaps that narrow path to soft landing widens out a little bit. I think that's why the Fed has been preemptive in talking about rate cuts. They're looking at the progress on inflation and saying, as long as we get a little bit more confidence, we can cut rates. So even though the inverted curve might imply a recession, I think if, and it's a big if, inflation stabilizes or goes back, bumpy road, but goes back into disinflation, and the Fed starts to cut rates a little bit, they're going to ease financial conditions enough to keep growth going. And I think then that path, you can get that soft landing, even in an inverted curve.
All right, Priya, we appreciate it. Thank you very much. Good luck with the view. Priya Misra, fixed income portfolio manager at JP Morgan Asset Management, is standing by.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We cover all the news in economic and financial world with our top analysts over at Bloomberg Intelligence. They cover 2,000 companies, 130 industries around the world. They're honestly probably the smartest people that we talk to in this business. Anurag Rana is one of them. He's Bloomberg Intelligence senior technology analyst, and we're talking Amazon. So that stock up doing pretty well. It is up by about 3.3%, having a nice surge yesterday when reported after the closing bell, and was all because of cloud sales growth and AI demand. Anurag, what was your big takeaway from yesterday and the call?
Yeah, I think the big spike in AWS profit is something that really alarmed us because, that was a number we weren't expecting for honestly a few years. So if you look at it, AWS margins, operating margins came close to 38%, little over 37. And that was like 8 points or 8 percentage points higher than what Street was looking for, and 14 percentage points over last year. Absolutely phenomenal. I think that's really what I am hoping that investors are focused on rather than all the other things.
All right, Anurag, give us a sense, if we just step back, for those of us that aren't cloud aficionados, give us kind of the market share layout. How does this market look between some of these big players like Microsoft and Google and Amazon?
So Amazon only plays on the infrastructure layer, which is trying to give people raw material to build their applications. And with that, they have a commanding market share, over 40% of the market. And in fact, they have maintained that for a while, which is surprising because Microsoft has been gaining share on it for a very long period of time, but from smaller players. And also the market's growing very much. So Amazon's currently at revenue of over $100 billion in this market. But overall tech spending is north of $2 trillion, frankly. So there's a lot of room to grow for everybody, not just Amazon, but Amazon, Microsoft, Google, even Oracle. All of them will grow in this market.
So if we take a look at the different layers of how AI kind of plays into cloud, the one area where Amazon maybe isn't getting as much market share, and maybe they're still developing that, is the consumer-facing side. What can they do there? What is their growth opportunity there?
Yeah, they have a lot of, I would say some apps that are working on it, but really the reason why Microsoft is ahead right now in that game is because of OpenAI. They have a partnership with OpenAI, and they run OpenAI's backend, which is when you do a search on ChatGPT, Microsoft is running those searches in the background, or the application runs on it, which is why Microsoft is getting the benefit of it. For AWS, the big benefit is going to come from companies or big corporations when they go out and build their AI applications. There's a high likelihood they're going to choose AWS as much as they're going to choose Microsoft or Google, and that's really what Amazon's betting on.
So you mentioned the margins, high margins at AWS. Can they maintain those margins? What are the risks for those margins?
Yeah, I don't think they can maintain them only because they have to spend a fair amount of money in order to reduce, in order to fulfill the demand, expanding in data centers, buying new hardware, buying chips. So I'd be very surprised if we see that number again for a very long period of time. And frankly speaking, I'll be happy with a 30% margin for the next several years while they make sure that they are doing the right investments to drive double-digit growth rate on their top line.
Let's talk about those investments. So they said they're going to, quote, meaningfully step up their CapEx to pay for all this AI infrastructure, but there was no number given. When Meta said that, the market didn't like it. What was the pass here that Amazon got?
Yeah, but Amazon's basically showcasing that they actually have been doing this successfully in terms of expanding data centers based on the capacity. So, before going in, they had close to $15 billion yesterday in the first quarter in terms of capex, and it's going to go up over the next quarter. So we think it's going to be north of 65 billion at this point for all of Amazon, with most of it going to AWS. But there's a reason for it. They are getting contracts to fulfill cloud demand, or they need to be able to expand that to fulfill that massive cloud demand.
Anurag, you know what I did not see yesterday in the release? A dividend. What's up with that? They got like $60 to $80 billion of free cash flow.
Yeah, I mean, again, they're going to spend that $65 billion next year on capex also. So I'm okay with not having a dividend for a while. I would rather.
But you're a tech analyst. You guys think that if you put out a dividend, it signals that you're no longer a growth story.
Yeah, it's a kiss of death. I'm not a big fan of it.
It's not. Microsoft, Google, Apple, they disagree with you.
Yeah, IBM kind of agrees with me at this point on that. I mean, but
yeah, go ahead.
Yeah, so look at IBM. I mean, they have a massive dividend yield. I would rather they take that money and buy a bunch of new HashiCorp kind of companies that are growing at 15 to 20%. That will change the face of the company, make them even more relevant in the tech space than they are right now. So I'm always in that camp that when you are a tech company, you gotta constantly reinvent yourself. Otherwise, somebody will come and eat your lunch.
I mean, Anurag and I, we just fundamentally disagree on this. We agree to disagree. We go to our separate corners.
Can I ask a dumb question for the two of you then? Is there room for both of you to be right? Like, can these tech companies throw off enough cash that they can reinvest in a healthy way and also pay a dividend?
Yes.
Anurag?
Yes, absolutely, Alex. I completely agree with that. Because what happens is if you give a very small token dividend, it opens the doors to a lot of institutional investors that are bound by their charter to only invest in companies that pay a dividend. So there is a logical reason to do it, but I'm okay with Amazon's going to take a year or 2 years to get to that path.
All right, so there's a where you can both be right.
There's a place where we can meet in the middle.
Is there a capex number that you wouldn't like from Amazon? They didn't give a number.
No, not at this point. The only reason is because we see forward contracts. As of this morning, when they filed their 10Q, we saw cloud commitments go up 29%. I mean, that's a very big number. And frankly, when on the enterprise side, we haven't even seen orders coming for AI at this point. AI orders are only coming in from consumer applications like ChatGPT, people running that at this point. Over the next few years, we should see a massive spike in people creating new applications or companies creating new applications, and that's going to only drive more growth for AWS, Microsoft, and Google.
Anurag, I just punched in Microsoft here. I'm surprised that the stock's only up 5% year to date. I thought it would have been more. It just seems like everything's going their way. What's the Microsoft call here?
Yeah, if you go and look at all these big companies that are supposed to be the big beneficiaries of AI in the long run, they had a phenomenal last year. I mean, it's just, you just can't deny it that the last 18 months have been really good for the entire tech space, whether it's Microsoft or NVIDIA or Amazon. So I think there's just that digestion phase at this point to see how things end up. There's an election coming, the interest rates are going up. So there is a fair amount of uncertainty out there that how will demand shape up in the second half and next year.
Okay, we have 30 seconds left. Apple tomorrow, what's your number one thing?
Good question.
Yeah, the only things I want to hear is China and stabilization, and then I'll be sleeping happily. I mean, other than that, it's going to be a bad number for Apple.
Are we going to get that? China and stabilization?
Well, we're going to get a disappointing number from Apple, but again, as Anurag was just saying, it's all about China.
Right, but also, can you stabilize versus increase, I guess, would be the distinction. Hey, Anurag, great stuff. We appreciate you. I am sure we'll be talking to you tomorrow as well. Anurag Rana, Bloomberg Intelligence, a senior technology analyst, joining us on Amazon as well as Apple. Do you think if they have China not growing but flat, that would be good enough?
I think if I were an investor, I would be happy with that, because my concern is it's a secular declining market simply because they're losing market share.
Yeah, all right. Good point.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.